G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Be sure to check out my links below, including exchanges I use and social media content that I post. Alright, let's go. So the topic for this video, we'll be going over recession indicators. I've got a few of them to show you in today's video to see if we are indeed in recession for the USA or we're not quite there yet. We're on the brink of one. And I've made recession videos previously discussing if we are in one. And there are, there's different talking heads saying that we are in recession, and some are saying we're not quite in one yet. So there's different opinions going out there in the Twitter space and the YouTube, different economists and different people. And my resolution I'll show in this video, I'll talk about at the end, the USA, it's to see if we are in a recession or not. It depends on three indicators, and that's all be in line with each other. If that doesn't happen, thereabouts, nothing's a certainty, only probabilities, but the best chance and the best, result will be when these three align, and there'll be a recession. Okay, so not to be something to freak out and go crazy about and sell everything now, and it's all, the end of the world's happening in the stock market and crypto market and any other markets that you participate in. It's just showing you what's happening. Okay, so that's the video. And before I really get into it, I did say in the last video that I'll be doing 3 videos a week, Tuesdays, Thursdays, and Saturdays. I do some shorts and that, but I did backstep that today. I had a really big think about it. It's difficult to really schedule videos and have a set content for each day on the 3 days. And I just want to talk about whatever's happening. It's because things do change, news events and market conditions and economic news. And just, talk about different, because whatever I feel like talking about is what comes out the videos. So, all right, that's I want to just make a video every day, if I can, and maybe exclude weekends or just during the week, and not really stick to a schedule. Just post at night like I've been doing, okay, late at night in Australia, or in the morning in the European countries and early morning in America, to cater for that audience more or less, because my content is more US targeted, as the global economy really revolves around the US as a dominant reserve currency and military power and, economic leader. So that is that. So get into the video. Okay, so we have the first indicator we're talking about is GDP growth. And this is one that is quite interesting, and it's triggered in the past, and it hasn't occurred. Recessions haven't occurred, and more or less every other recession, or the recessions, have triggered because of negative GDP. There has to be a factor in the recession. It has to be 2 negative quarters to define a recession. So basically, 2 quarters is 6 months worth of economic data, GDP numbers, gross domestic product, the US, to mark recession. So if we go back to the 1947 period, okay, as you can see there, there's 2 negative quarters. And what I'll do is I'll bring up notes, okay. All right, hope you can see that one. So, 1947 I marked here, and I've gone through this. I've gone through all the data. There was 2 negative quarters of GDP, but there was no recession, okay, that year. 1949, you had 2 negative quarters. You can see back to back, quarter 1 and quarter 2, both negative, and we had a recession. So that did mark a recession, 1949. Okay, and we had one just after it, so we had a positive one, and then we had all the way at negative. So we had 4.2%, so a big shoot up, and then a big shoot down. So these things just do fluctuate up and down. They're not predictable at all, like a trend. So there's up and down like a zigzag. Anyway, that's that. And then 1953, and going to 54. Okay, so you had negative Q3, 53, and then Q4 was negative. That was a recession. Okay, we had 1956, Q1 and Q3 in 1956. And as you can see on the notes here, that wasn't a recession. Okay, so we had 2 negative quarters, and it was a recession. Then 957 happened, and then we had 957 Q4, Q2, and Q4. Okay, so 2 quarters, and then another quarter after that. And if you look across here, that was a recession in 58, but it was really an early sort of trigger in 57. Then going into Q4, okay, the end of that year, and then another one back to back. So these two back to back really sort of solidified the chances of recession, and it did occur. Okay, so it happened there, 58, 960. You had Q2 minus 2.1, and then Q4 of 1960. Okay, -5. So they weren't back to back, but they had one positive in between, and it was 2 in the same year. Okay, that's what I'm trying to really outline. 2 quarters in the same year. And 960, as you see, it's not on this list, so it was a recession. Okay, there was definitely a recession there. 969, it was back to back, quarter 4, and then 970 Q1. So this is really an overlap of 2 different years. But going into the 970 period, it's predicting the recession. We're pretty much calling a recession in 970. So you look at this list here, and it definitely was a recession. It wasn't on this list. It did occur. 970 again. Okay, so following this recession, you have another negative quarter on its own. There's 2 separating it, and right at the end of that year, we did have another negative quarter of GDP. Then go ahead, 973, negative 2.1, 74, Q1, it's negative, Q3, Q4, and Q1 of 75. So 73 and 75, there was a big recession there, big period of drawdown from 73 to 75, and that was a recession. And then we had this yellow here, so 2 negative quarters in a row. So Q1, Q2, Q3, 980, and that was a recession. Then we had 981. We had a negative Q2, 2.9%. And then in Q4, right at the end of that year, we had another negative quarter, and that was a recession. Going into 1982, which is a period there, which had some slowdown, and that was recessionary period. 990. So 8 years later, we had negative Q4 and then negative Q1. So that was recessionary as well. So 2 quarters back to back in 1990, 1991. It was a recessionary period. So it did work there, 2 quarters, and really overlapping both years. We had 2001, so Q1 and Q3 that year, and that was a recession. So another recession called perfectly. 2008, obviously a recession, GFC, minus 1.7 in Q1. Then you had Q3, Q4, Q1 of 2009, and then Q2 2009. So this is a lot of negative quarters there. And as you can see, it was a GFC crisis, of course. Then we had an outlier again. So this one, 2011, we had negative, just negative, -1. Then had a positive, then a negative. So 2 in the same year. Okay, so 2 negative quarters in 2011, but we didn't get a recession. So I've written this down in the notes, 2011. 2014 was just the one. Okay, so if you really want to say you need 2 quarters, you can not include 2014 because that was only the 1 quarter there. So that you can not include that. You need 2 negative quarters. So ignore that one. 2014. And then we had the 2020 pandemic crash. Of course, we had 2 negative quarters there. Q1 and Q2, which is a big crash. And unemployment just went through the roof. And obviously that was a recession. And to 2022, recently, we had 2 negative quarters. So you had Q1 and Q2 of 2022. And that was supposed to be a recession, but because the Fed was reacting to inflation, it didn't occur. So that was not a recession. So I've written it down here. So these were the years that we didn't have recessions: 1947, 1956, 2011, 2022. And we had 2 negative quarters of GDP growth in those years. Okay, so there was 4 years where it didn't work, but every other recession, it nailed it. GDP absolutely nailed it. So on its own, it's done a great job. Okay, but like I said, there's outliers. There's these 4 outliers, which can be false signals. And that is that. So those GDP numbers. Next chart, this really goes back to the 80s. So it's not as you can't really match up the periods, but nevertheless, it did work every single time. So we had a yield curve inversion here in 1980, and boom, as soon as we uninverted, we had a recession, 1981 into 82. As you can see, this shaded area is recessions, and as soon as it came back up, spiked back up there, after it went below this zero black line, spiked up, and we had a recession. Okay, so it was 80 and 81, 82 sessions. Then you had this here, so it went below the zero line, the 10-year versus the 2-year. Okay, that's what it is. And the yield curve went back up, and it steepened, and recession happened in 1990 and to 1990, right, 1991. Okay, so really end of that year to 1991. We had the same thing happen again. We had a false here, 1998. We had a false inversion and uninvert. So it was a false signal. But as we know, the GDP numbers, there was no negative GDP in 1998. So that was, you can't really say that all. You got to combine the two, and it didn't occur, which makes sense. We inverted again in 2000 and uninverted and recession. So it was the dot-com bubble. Obviously, the GFC, we inverted and uninverted and had that 2008. And 2020, we just slightly went below zero and uninverted, and we had a recession in 2020. So it was 2019, we did a little bit of an inversion and uninversion. So that's that. So these ones here are in line with GDP, okay? Except for this one, which was an outlier. So that is that. But you've got to combine them two together, okay? So far, these two play hand in hand with recessions. And then the last one, we're going over the SARM rule. Okay, this is unemployment data. So we talked about GDP, just gross domestic product, and we looked at the treasury yields, the 2 and the 10-year inversions, which caused recession, the steepening of the curve. When yields fell on both of them, but the 2-year fell more aggressively than the 10-year, and that was the recession. The Fed cut rates and recession. So now we're looking at the SARM rule indicator, okay? So this is pretty well accurate. It's very, very good. It's just solid. Solid on its own. It's very solid, okay? So in 1949, we had recession. So these are reds are obviously recession shaded areas. So recession here, as soon as we went above this 0.5 line, this yellow line, okay, which is the percentage change in unemployment rate for 3 months of data, I believe it is. And when we had that sort of increase in unemployment and above that 0.5% round, recession every single time. So this 1949 recession, 1954, 53, so 53 one was a recession, okay, as we talked about before. We had 1958 recession, went above it. It was a fake here in 59. So it was a false. So it was one out of the whole history of it, false. There's one false, okay? So it's not really perfect, but there's one false nevertheless. But that was November 1959, so basically December. And then if you go to where it started, it was literally 5 months later, 4 or 5 months later, the recession occurred. So it was an early signal that was a recession coming. And we did cross again and confirmed with the nice close above it that 960 was a recession. Then we had 970 recession, obviously 73, 74, and into 75. It's a long period here, but recession did occur before this crossed, but nevertheless, this confirmed that we were in a recession. Okay, so it was definite by then. That was sort of a third of the way in, and then you had 980. So it's just not important to know that it could be late and begin lagging. This recession occurred before it crossed. Okay, so it's happened before here, but it happened right at it. Okay, so perfectly there. So 980, we're talking about recession. Similar here, right at it, just about, like pretty much at the same time. And 1981, 1982, we had recessions. 1990, as we mentioned before, and 1991, recession. And the timing was perfect on those two. Timing again was pretty well good here. The SARM rule in 2000, dot-com bubble. And then we had the GFC, of course, and a massive spike, and that was a recession. And then 2020 just went through the roof, absolutely exploded to the upside like a rocket, and recession. Okay, and now we're doing it again. In 2024, we're actually above this 0.5 at 0.53, and I need to see another push higher to really confirm the recession and not see something like a 959 where we just spiked up and went down. Okay, so that was only one time in history out of the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12. And we had 13 signals, so 12 out of 13 were accurate, okay, which is a good track record for the SARM rule. And I'll just bring up notes again. As you mentioned, so 947, 956, 2011, 2022 were years that were no recession, and the SARM rule didn't trigger in those years, okay? So we went over that, the SARM rule, and eliminated all those years. So it couldn't have been recessions anyway because the SARM rule didn't trigger it. So that's that. All right. So that's the notes there. So if we bring this aside, okay, and you bring up the yield curve, so you match them up, okay, and you just go back in time, and you can see that 1980 and 1980 recession, and recession here, so it played out, and 1981, 82 worked. It worked in 2000, of course. You know, they're both recession. 2008, obviously, yes, they both lined up. And 2020, yes, they lined up. So these two were in line. And then you go back to GDP numbers. Okay. And it was every year that I mentioned on here, which is the negative 2 quarters in a row. So 47 was no recession. And the SARM rule did tell us that. And 2 there, it was 949, and you go back to the SARM rule, and I'll just make it a bit easy to see, as you can see there. And obviously 49 was a recession, yes, so that was correct. And then we got 953, yes. 956, no, because the SARM rule, it was 54, 53, and there's a gap between 56, 57. So both those years, there was nothing. And then it was a session at the end of 57. So it was sort of quarter 4 of 57. It started to 58. So if you go back to here, so it was quarter 4. So see at quarter 4, see the first negative GDP number, and then the quarter 1 of 58. So the overlapping, the 2 years, which was exactly what the recession occurred here, okay? So that was yes. Then we go fast forward to 960. Yep, 960, so 2 negative quarters. Yes. 1970, 2 negative quarters. And yes. 1973 to 1975. And 1973, yep, to 1975. Yes. And then we go to 2 negative quarters here in 1980. Obviously, yes, we just talked about that. 81, 82, yes, it's just here. 990 to 991. 990 to 991, yes, correct. And then you go to 2001, sorry. And yes, very short-lived recession. It was a big drop nevertheless, 2000 to 2003, but the recession period was 2001 because of GDP numbers, okay? So that was that. And then we had 2008 Q1 to Q2 of 2009. Yep. And yep, to Q2, correct. So, yep, so Q1 to for a whole year, essentially, just over a year. And then 2020, and obviously, yes. So each indicator stacked up. And I've showed you all of them. And the 4 outliers that were on the GDP chart and the 1 outlier on the SARM rule. And we matched them all up and we got the result. Okay, so very accurate, 100% accuracy when the 3 counted with each other. And what we're seeing right now is no negative GDP in 2024. So in 2022, we had 2 negative quarters, but the SARM rule didn't trigger in 2022. So no recession. Now we're seeing a SARM rule trigger. Okay. We're seeing the yield curve invert and then start to uninvert. So those two are lining up, okay, signal recession. So those two are the Treasury yields and the SARM rule are in 2024. But the only thing that's not lined up is GDP numbers. We don't see negative yet. You need 2 quarters of negative GDP to confirm that we're in recession. So that is that. I hope you enjoyed the video, just going over the 3 recession indicators and lining them up, going back to historically, back to the late 40s to now, and seeing in 3 collectively to show that they have to be combined together to confirm recession. And I showed you pretty clearly the outcome of that and how 100% accuracy, the 3 combined together to predict recessions. So that's happened. And yeah, at the moment, 2024, we don't have a recession because the negative GDP hasn't happened. Waiting for that to occur. And need 2 quarters to confirm that we are in a recession. It's happened historically, and this time can't be different, okay? This time is the same. So we wait for that negative GDP numbers. So far, we're not in recession. It's the US, okay? So I thought we were. I thought the SARM rule triggered. I'm like, yes, we're in a recession. But nah, it's not. You can't just look at one. You look at multiple. And we did. We showed you how accurate they were and how stress-free and robotic and common sense it is just to look at the charts. Go, oh yeah, it's easy. You know, that's recession every single time. So yeah, going back to the late 40s. So I can't go back any further. And the Treasury yield, I couldn't go back further for that one, unfortunately. So that's just stuck with the data there. But that is what we came out with, and we had to put up with it. So anyway, that's that. So if you enjoyed the video, please smash the like, comment your thoughts below, subscribe to stay updated. Be sure to check out the links below, and I'll catch you in the next one. Cheers.